The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
A rebound in equity markets. The question is, how high and for how long? Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Boston.
And I'm Alex Dale. I'm still seeing sell the rips. I haven't seen any changes yet. You?
No.
Yeah. Okay. So we'll see how much we go as we head into the close here. So just to keep score, S&P is up by 0.8%. We did breach that correction territory, down 10%. We got to about 9.1%, and now we're rallying off of that level. Nasdaq 100 also up by a full 1.5%. The VIX calming down, but we still stay elevated at 24, Romaine, and we're still there's a very strong 10-year auction that happened at 1 o'clock. We are seeing a little selling with yields up, but clearly it's the bond trade at the moment, Romaine.
Yeah, and then when we go back to that equity trade, this really is one of those rallies, Alex, where maybe there might not be a whole lot of conviction behind it. The majority of stocks are not participating. While there are about 200 S&P 500 stocks in the green, the point gain on the index really attributable to just a few names: NVIDIA, Tesla, Meta, Broadcom, Microsoft, Amazon. That's pretty much it. So the question really becomes how much rebound is actually in this rebound. Now, we did get a reprieve today on the economic front. That was largely due to that benign consumer price index report, a report that did show inflation rising, but at the slowest pace in about 4 months. Yes, rent and food costs, they're still climbing, but there were noticeable declines for airfare, for cars, for furniture, and even some electronics. But it's kind of hard to celebrate knowing that the effects of tariffs on the economy wouldn't have actually been reflected in last month's data. The biggest tariffs so far out of the Trump administration, 25% on steel and aluminum, they only came into force overnight. And as expected, they triggered reprisals from Europe and Canada. American whiskey maker Brown-Forman plunged as much as 7% in the day. Chicken producer Pilgrim's Pride, motorcycle maker Harley-Davidson, each sliding the most since October. And that, the effect of U.S. tariffs, and more importantly, the retaliatory ones on the U.S., raises questions as to whether the stock market meltdown that we had over the last couple of weeks, well, did all of that actually shake everything out of this market?
Did it? And exactly. Are we going to find some stability? What would it take to find that stability? Now, taking a look at, say, the fund positioning, so CTAs, commodity trading advisors, volatility funds, et cetera, and I know they're not a huge portion of the market, but they can introduce upside or downside on a day-to-day movement. And this chart comes from Goldman Sachs, a prime brokerage unit. Now, the line you can't really see here, but it goes all the way down to -4. It's the biggest de-risking activity by hedge funds on Friday and Monday. The largest in 4 years, and it ranks as one of the top events, Romaine, over the last 15 years. And so the question is, after those two moves, Friday and Monday, is that type of selling done, which means that exacerbation to the downside could maybe find some stability, and potentially if we see a rally in the S&P, does that actually ignite funds to buy, which helps move everything to the upside? Can this positioning be a source of stability?
And it is an important question, and we're going to try to answer that today with Binky Chadha, Chief Global Strategist and Head of Asset Allocation over at Deutsche Bank, joining us here to kick us off to the close. And I will basically just take Alex's question and pose it to you. It's a nice reprieve today, but should we be concerned that we might see a resumption in that sell-off, that drawdown that we've had over the last couple of weeks?
Yeah, we think so. You know, a very simple way, as Alex already started to get into, is to think about equity pullbacks as, you know, where was positioning, where is it now? And what I would say is positioning was very overweight, as everybody knows, has come down very sharply, as everybody knows. And I would say overall equity positioning today is actually just a little bit underweight. And you know, there are many drivers of positioning. And in the current context where, you know, trade uncertainty continues, basically, and then certainly right now, I would say, you know, it's likely to continue till early April at least. You're going to see positioning basically come down. And I would get into a little bit the discretionary investors who are focused on the fundamentals and what, you know, all of the developments will do, versus the systematic strategies. And I think, you know, you want to keep in mind also the context before the sell-off began. We had a 4-month period basically where the equity market, the S&P 500, was basically in a very tight plus minus 2% range. Right. And why that's important is that's following basically 2 years of 24% up, and that means for systematic strategies, a very, very strong trend that then basically went to zero for 4 months. So there's the vol, there's the trend, and that argues for systematic strategies to continue to basically cut positioning.
Well, for the fundamentalists out there, is there something fundamental to hang your hat on? I mean, the earnings season wasn't awful, and I don't know what the next earnings season is going to look like. The economic data we've gotten up to this stage, and I know it doesn't really reflect some of the changes coming out of Washington over the last few weeks, but so far that is relatively decent. It may not be as great as we wanted to see it, but people are still spending, people are still employed, and we still have GDP running above long-term averages.
I think the economy is in very good shape, not giving up on a constructive outlook at some point later. But right now, it's really all about the pullback and how far it goes. And you know, what will essentially resolve it. I would say, you know, the impact of the cumulative uncertainty is what I would worry about in terms of the economy. What we've seen so far is confidence measures come down, consumer confidence, and I would say not enough attention is paid to CEO confidence, which we think is absolutely key for the cycle. There's only one recent printout from the CEO magazine, and that's basically seen, you know, CEO confidence basically fall off a cliff. I mean, it's not only below 2022 levels, you have to go back to 2012 after the European financial crisis to find the level. I'm not just talking about the change, it's the level of confidence is extremely low.
But it can move fast, like as we've seen to the up or downside, so there is that. Can we just take a look a little bit at the trade of U.S. exceptionalism to European exceptionalism that's unfolded a little bit? We just had the Bank of France, though, cutting its GDP forecast because of U.S. tariffs for this year and next. Can European exceptionalism be a thing to invest in?
I'm not necessarily, I wouldn't necessarily call it exceptionalism. I didn't think about it as U.S. exceptionalism. Okay. I would argue U.S. growth was really, you know, pretty normal. I mean, if you think about trend channels or trend lines, I mean, we just went back to the trend that prevailed before COVID. And we did that 3 years ago. We haven't really budged from that trend. We may in the first quarter, but so far, you know, we haven't. The issue with the rest of the world was that it began to recover from COVID, but that came to sort of a full hard stop in the second quarter of 2022. And since then, activity levels have gone sideways. Now, as we've said many times in the past, if the intrinsic dynamics were bad, we should have been going down. We went sideways. So there was a risk we were going to get a recovery anyway at some point because there's much greater exposure to manufacturing. Manufacturing's been in a funk. That's just a hangover from COVID, the post-COVID boom, actually. And so you have forces basically arguing for growth. And if you think about things in terms of change, what's changed in the U.S., you know, for the economy and earnings is uncertainty, arguably negative. Whereas in Europe, we are getting change. So that is a positive. And equity markets will always move before waiting for the hard data. Yeah. So, so we are overweight Europe. We got it at the right time. We are still overweight. The question that you're asking, I translate as basically, we got this positioning bounce because everybody was underweight Europe. You have basically a potential catalyst. So we moved our ratings in anticipation of people potentially covering their shorts and underweights going into the German election. And they did. And then we have basically the post-election results where I would argue, you know, the surprise has been massively positive, potentially game-changing, and so we are staying overweight. So whether you want to call it exceptionalism or catch-up, it all works.
Sure. Yeah. We only have about 40 seconds left, but when do you buy U.S. tech again?
U.S. tech, I would say it's pretty appealing right now on a relative basis. I mean, if you look at a long-run chart of mega cap growth in tech relative to the S&P 500, you know, yesterday it just popped a little bit below the trend channel that it's been in for 15 years, and today it's bounced. So is that coincidence? It could be, but we are just like right back at the bottom of the channel. So. And considering the growth fears, you know, tech has been treated as defensive, when there's not a lot of clarity. But tech is also, very exposed to the rest of the world, foreign sales, the U.S. dollar, so. It's not clear. We've been neutral for quite a while, and we remain neutral. But it's a question to ask every morning, I would say.
All right, Binky. Always illuminating talking to you. Binky Chadha, Chief Global Strategist and Head of Asset Allocation at Deutsche Bank, kicking us off to the close here on this Wednesday afternoon. A deeper dive into economic conditions as well as that CPI report. Sree Kochugovindan going to be joining us from Aberdeen. This is Bloomberg.
The equity move today helped by that cooling February CPI. Some warning signs. Falling prices in consumer discretionary areas like airlines. Prices there falling 4% month over month, the month since June, dropping 0.7% annually. And this comes as airlines also this week are warning of weaker demand ahead. Here with her perspective on what it means for the broader economy is Sree Kochugovindan, a senior research economist over at Aberdeen. Sree, good to see you. Thank you for joining us. What did you make of the weakness in pricing for some of those consumer discretionary items?
Yes, I think there was an interesting trend there. Some of these items were actually volatile items and a bit of a payback from recent months. But I think overall, we won't get a clear steer in terms of the translation into core PCE until I think it's tomorrow when we start to get the PPI measure as well. And that will give us a better signals, particularly for core services, which is going to be quite important, given that that's still quite elevated, relatively sticky at around 4.1% was today's core CPI, core services year on year. So there is a good trend there. The fact that it was softer, that's good news. However, we do have a lot of uncertainties going forward. And I think that's the problem for the Fed. Looking at these numbers here, as Powell has already said in his recent speech, it's all about trying to extract the signal from the noise and trying to account for some of the uncertainties that are ahead in terms of the impact of tariffs and how that could be filtering through into inflation in the coming months.
Well, that's the next question I had. How will it? How does it filter in? How soon does it filter in?
Yes. I think it will take a number of maybe 3 to 6 months. By the end of the year, we'll get a better measure. But first of all, we don't know a number of different factors. How comprehensive will these tariffs be? So we have a couple of scenarios that we're really focusing on. We can have, we've already seen the announcement that aluminium and steel tariffs are in place. In April the 2nd, we'll have sector-based for autos, semiconductors and pharmaceuticals. Those are all going to go through, perhaps, in April the 2nd. So we don't know how long they will be in place. And one key question is, are these a negotiation process or are these really revenue generating? And there's a constant sort of to and fro in terms of the signaling that we're getting. So we had quite an interesting set of interviews recently. Peter Navarro had a discussion with one journalist saying that this is a negotiation tactic. Yeah. Yet then, so it's very confusing to see how long will these tariffs actually stay in place once they're implemented? And that's key for inflation. So the estimates sort of range from 0.5 to 1% in terms of a level shift in inflation if the tariffs actually are maintained through the year. And this will filter in over a few months once they are implemented. But then, of course, yes, of course.
So that's kind of how the hard numbers would feed through into the broader economic picture. I am curious, though, about sentiment in general and whether the chaos that's going on that we've seen rattle the market, and now we're getting some evidence it might be rattling consumers, that even if these tariffs never come to fruition in full, as have been threatened, has some of the damage been done? And I raise that question because the CEO of Brown-Forman speaking just a few minutes ago at a UBS conference saying that they're already seeing consumers trade down. And that's sort of independent of the tariff discussion. He's basically just saying there's been softness there. We heard from, obviously, the airlines and some of the retailers yesterday and last week that also seem to suggest that people are pulling back, not because they don't have the money to spend, but because they just don't feel comfortable spending, Sree.
I think that's a very important point and a key concern for the outlook going forward. Now, if we look at some of those surveys, whether it's business sentiment or consumer sentiment, Part of the story is that there's a pullback and a normalization from the surge that we saw post-election. So initially, there was the assumption that we'd have deregulation, tax cuts, and that would be good for the economy in general, whether it's corporate profits or consumption. So there was a surge in sentiment as a result of that. Now that's all being unwound. So we're back to the level pre-election, in essence. Now it's a question of what happens from here, because persistent business uncertainty affects investment decisions and spending decisions, exactly as you say. So that will be a problem for the Trump administration if this uncertainty continues.
Yeah.
So negotiations need to be wrapped up relatively quickly in order to prevent some more serious spillovers for the U.S. economy.
So, Sree, I'm just curious. We only have about a minute left here. But when, as an economist, when do you actually start to really model in economic softness? We won't call it a recession, but just the idea that whatever growth estimates you had coming into this year, that they need to go lower. Is it too soon to do that now?
I think it is too soon. At the moment, it's a case of looking at scenarios. So you can do a number of different versions of this, but the way we look at it is, what is the average weighted tariff under different scenarios? So if we take a combination of, say, just looking at reciprocal tariffs with some carve-outs, so higher blanket tariffs on China, there you see an average weighted tariff in the region of 9%. So the filter through from there is much less of an impact than if we say we see an average weighted tariff that goes back to the 1930s levels. So if you actually collate everything that's been announced so far, including VAT and some non-tariff based trade barriers, that is all quite meaningful and can go back up to like 14% or so, or in excess of 20% even. So it really, we have a bit of an extreme scenario there that we unfortunately can't quite rule out. And the probability on that extreme scenario has started to edge higher, and that's a concern.
Sree, always a great conversation. We have to leave it there. Sree Kochugovindan, she's senior research economist over at Aberdeen. A closer look at economic conditions as we move back to the market, and some breaking news out of Washington. That antitrust probe that we learned about that was opened by the Federal Trade Commission in the U.S. under the Biden administration, we're now learning that that probe is going to continue under the Trump administration. According to people familiar with the situation that Bloomberg reporters have spoken to, the new FTC chair, Andrew Ferguson, appointed by Donald Trump, is going to move ahead with that sprawling antitrust probe of Microsoft that was open in the final days of the Biden administration. And Alex, of course, a lot of this has to do with their AI operations, sort of what they knew before they took that investment in AI, what they did after it as well.
Yep. I also wonder if we can extrapolate towards how generally we'd see M&A and antitrust within the Trump administration, or is this a Microsoft-specific issue? Yeah,
that's a big question here. We're going to try to get you some more details on that. Stick with us. This is Bloomberg. All right, let's get a view from the sell side. Top calls, big movers on the back of analyst recommendations. And we start off with Rubrik, a buy rating for the software company as Rosenblatt Securities upgrade, saying Rubrik has a next generation platform for data backup and recovery, and benefits from AI proliferation, and benefits from increased dependency on cyber security. Those shares up 6.5% on the day, best day since early December. Not such a good day for Verizon. Wolf Research cutting its recommendation to peer perform. Peter Supino, the analyst there, says Verizon's warnings of a challenging quarter ahead adds to concern about its ability to maintain costs. Those shares, which plunged 7% yesterday, down 2% today, worst two-day slide going back to 2023. And finally, PepsiCo, Jefferies downgrading to hold from buy. The analyst says current price on the stock offers a limited upside, especially at the company's Frito unit continues to struggle. He advises investors to buy elsewhere in the sector, particularly at competitors like Coca-Cola and Keurig Dr. Pepper. Those shares down 2.5% on the day, and those are some of our top calls. We stay in the consumer staples space. That has been a big focus for us. Of course, with the big concern right now about consumer confidence, consumer spending, and how tariffs play into it all. Joining us right now to talk a little bit more about this is Filippo Falorni. He joins us for more on this as the lead analyst covering U.S. beverages, household products, and personal care over at Citi. Consumer spending, even in a dips a little bit, to a certain extent, should hold up for staples. You throw in tariffs and whatever pricing power some of these companies have, do we need to start rethinking the valuations of some of these companies?
Hi, Roman. Thanks for having me. Yeah, look, I mean, the Staples Group is still trading below its historical average premium to the S&P. So there's definitely, from a valuation standpoint, I definitely agree with you that there's probably some further upside potential for the group. However, the fundamentals haven't been great across the board. A lot of companies are talking about the consumer being incrementally more cautious in their spending behaviors, trading down and seeing some pressure in terms of recurring purchases. So it's not that the Staples Group is totally immune, but to your point, on a relative basis, relative to many other sectors, trends are generally more stable compared to other consumer companies.
Of course, we come into today with the biggest tariffs that the Trump administration has promised kicking in, those 25% ones on steel and aluminum, more tariffs promised. With the companies that you cover, what is that exposure to the import market, and for that matter, even export market as well, when we start to talk about the potential for retaliatory tariffs?
Yeah, absolutely. That has been a big topic in my sector, the tariff implications. Look, on aluminum, they're obviously going to impact a lot of the raw material that many companies use, particularly the beverage companies, on aluminum cans. And so that's going to have an impact on their cost of goods sold, which ultimately these companies are going to try to protect it with productivity, but ultimately some of it might be priced with higher prices at the consumer level. And then in terms of like other big import exposure, the biggest one in my coverage is Constellation Brands, which imports almost 100% of their beer from Mexico. And obviously with those tariffs, that will be significantly impacted there. To your point on retaliatory tariff, I think that's an important point given the announcement from the EU today. One company that I cover, Brown-Forman, it's falling in the crosshair of that trade dispute with the EU because they export Jack Daniel's whiskey to Europe. That's about 20% of their sales. And they will be in a relatively disadvantaged position as they might have to take price in a market where the European whiskey, like the Scotch whiskey, might not have to take price. And so that creates some significant pressure for a company like Brown-Forman.
Right. It's the worst performing stock on the S&P today, Filippo. But what's interesting, if I take a look at a chart going back to the previous Trump administration, the stock actually was up like 100%, even though we also saw these headlines roll out, retaliatory tariffs also roll out. What is different this time?
Yeah, look, I think the demand environment is very different now. There's in spirits, there's been this pent-up demand post-COVID where a lot of consumer bought significant amount of inventory at home. Their bar carts are full. And obviously, spirits don't have an expiration date. And so there's a lot of inventory built up at home, and consumers don't necessarily have to purchase as much of inventory. So the demand environment is already softer, and you put on top of that tariffs that could create some implication from a pricing, and that creates even a more challenging environment compared, to your point, to the last time Trump was in office.
The stock down almost 5% today. If I take a look at estimated PE multiple at 18, is that accurately reflecting the risk?
I think, look, the risk is more on the earnings side more than on the multiple. If you run some math on the potential impact of the tariffs, the European tariffs on Brown-Forman, you can get 10 to 15% earnings impact. So to me, it's not fully reflected in earnings numbers yet. That's why the multiple looks artificially depressed as of right now.
Do any of these companies still have pricing power, at least that level of pricing power that we saw exercise in 21, 22, and even into 2020?
Yeah, that's a great question, Romain, because a lot of these companies took significant pricing in those periods, really 22 and 23. And so the consumer is already feeling the pressure of cumulative inflation over many years. So companies, as I mentioned, they're going to try first to offset tariffs with productivity because they realize that if you raise prices even further, the demand elasticity is going to be pretty significant. But in some cases, they might have to, right? Like, especially in the case of Brown-Forman, if they are on a relative disadvantaged position, the earnings impact could be that significant that they might have to take some pricing. Same with Constellation Brand with beer imported into the U.S. So there might be some exception, But to your point, I don't think you're going to see the same level of price increases that you saw in 22 and 23 because the consumer is showing that they can't take that much pricing anymore.
All right, Filippo, thanks a lot. We really appreciate it. Filippo Falorni over at Citi, thank you very much. Let's get back to that breaking news for a moment on Microsoft. Shares are lower as the FTC moves ahead with an antitrust probe. Actually, that stock up 0.9%. It rolled over pretty much flat, and then it moved up higher. Hey, Sarah Frier of Bloomberg joins us. Now, Sarah, is this a surprise to the market? Stock's taking it in stride.
I think there was a bit of surprise, just considering that we didn't know if the Trump administration was going to have a similar look at these big tech companies, considering how much they have done to try to appeal to him. There have been a lot of meetings between Trump and big tech execs. We've heard the administration repeat some of the favorite policy lines of big tech execs, but this is the FTC continuing what it started in the waning days of the Biden administration. There hasn't been a ton of turnover, and we do see the FTC moving forward with the Meta trial, which is set to begin in April, and the DOJ is continuing with the Google trial. So this is sort of the way things are for this. But this techlash actually started, we have to remember, it started in the Trump administration.
It did.
Lot of these probes.
I am curious, Sarah, though, what the complexion of antitrust enforcement or whatever the FTC is going to frame this, what the complexion is. And I ask that because Andrew Ferguson has done a few interviews, including with the Wall Street Journal, where he's been very critical of what the Biden administration did and Lina Khan, but he also made it clear that he doesn't necessarily disagree with the idea of putting pressure on these companies, not necessarily on the issues of, price and, the sort of typical economic, nerdy things that we're supposed to care about when it comes to antitrust. He seemed to be more focused on, woke ideology, and using his phrase, not mine, and other things like that. So is there some sense here that these companies are going to be under the gun, but just for completely different reasons, and maybe why the Biden administration had them under the gun?
It's possible. It may be a different story. And Microsoft isn't a social network or one that brings up algorithmic ordering of content, which you'll probably see a little bit of flavor of that if you look at Facebook, if you look at YouTube. But when you look at Microsoft, it's going to be a lot more about its hold on the business, the more classic antitrust case. I think that we'll definitely see. Traditionally, with Republicans, including Ferguson, it has been about that sort of free speech argument. Are big tech companies censoring conservative ideas? Are they, having too much power over the global conversation? And we've seen the companies make a lot of policy changes just in response to that pressure. No FTC investigation needed.
All right, Sarah. It's going to be interesting to see how all of this plays out. We should point out this really didn't affect the shares. The shares took a slight leg down, but stayed in the green, and now kind of pushing back, not far off the highs of the day. Sarah Frier, a nice look here and a great scoop by Bloomberg reporters. Speaking to people familiar with the situation, that FTC probe opened by the Biden administration on Microsoft, going to continue under Trump, but for slightly different reasons. It's 3:31 p.m. here in New York. We continue to count you down to those closing bells. A bit of a relief rally, Alex. I guess you can call it that, now that we know what the tariffs so far are going to look like, and you have that benign CPI report that maybe gives some people hope that economic conditions will hold up.
So I have been in Houston, Texas over the last 2 days.
Really?
A little tired.
How much sleep have you had?
Not so much. At the CERAWeek conference, where all energy leaders go and talk about the state of the industry, and behind the camera, it's all about pause. So no one's ditching projects or anything, but everything seems to be on pause. No one's going forward with any new kind of projects because of all of this uncertainty.
Well, and I feel like that could have more of a big economic. I mean, I know we always focus on consumer spending, but it's also like, there's so much money that these companies are pushing into our economy through their spending and their investments here. And if they are paralyzed, what does that mean for the rest of us? Yeah,
I was talking to Laura John Brown, who used to run BP a while ago. He's like, I've been in this industry, in this world for 60 years, and this is the most uncertainty I've ever seen. Wow. And he's lived through all kinds of different cycles. So for more on this, more insight on the markets as well, Ralph Schlosstein is Chairman Emeritus of Evercore. Ralph, always a pleasure to see you.
Thanks very much, Alex.
Would you agree? Would you agree with Laura John Brown?
I absolutely would agree, and I think that was a great introduction to, I think, what is going on in the world and in the markets right now. And obviously, historically, markets have not embraced tariffs. The markets have generally appreciated a more free trade environment. But leaving aside the substance, which is where I think we are right now, we're just focused on the uncertainty and the volatility. And that's what's troubling markets, and it's what's concerning business leaders who are responsible for making capital commitments, hiring decisions, and merger and acquisition decisions.
Exactly. And 6 years is a long time to have the biggest uncertainty be right now. And I'm wondering when those pause buttons become stop buttons or dump buttons.
Well, there, as you and I have discussed before, there is definitely a pent-up amount of activity where companies have been putting aside for a while their larger strategic decisions. I think the hope was that when the Trump administration came in, there'd be a little bit more yellow or green light to consider those things. And certainly among our clients, we saw over the last 3 or 4 months, 5 months, a significant reinvigoration of major strategic thinking, major investment decisions, hiring decisions. And right now, I wouldn't say that's stopped, but it's definitely on pause.
I am curious, though, is there any credence to the argument that we've heard from a lot of Trump administration officials that some of the stuff that's happening now, that's the bad, and they knew that it was going to be bad, meaning have a potential impact on the economy. But there are other policies, particularly some of the stuff that they're talking about with regards to the budget and other types of fiscal spending that they think will then be accretive to our economy, and that somehow that will balance it out. It's just the order that they're doing it is maybe throwing people off.
I think you have to, as I said earlier, separate the substance of the policy, and there may be some merit to the argument that you just made. We'll see. But what's going on now is away from substance, just the turn right, turn left. We're going to do this. We're not going to do this. And what is the rationale for, let's take tariffs. Stopping fentanyl at the border, stopping immigrants at the border, raising revenue, retaliating for aggressive actions on the part of our trading counterparts. What is it that we're really trying to address? And if we could get a firm handle on that, then people could pass judgments about what was likely to happen and what effect it would likely have. Right now, you just have super high uncertainty, as reflected, by the way, in the VIX.
Yeah, absolutely.
And that is the enemy of almost everything that all of us want to happen in our economy. Growth, investment, jobs, and strategic progress.
And it's not just rattling executives. Obviously, it's rattling a lot of our other countries and leaders as well. And I do wonder about the potential long-term damage to relationships with whether it's our allies or just other trading partners that we have. If they do feel like we are unstable or there's too much uncertainty, do they start trying to cut deals with other countries? And I know nothing ever is going to replicate the world's largest economy, but you can at least nibble around the edges and protect yourself.
I think if you think about the amount of uncertainty we have in this country, imagine the amount of uncertainty that you have in Europe in terms of what is the probable or likely action of their most important ally to all kinds of different things that could possibly happen in Ukraine or in Eastern Europe or in the rest of Europe. And so the uncertainty there is even greater than it is here. And some of this, there, regardless of your politics and your belief in policy, there are some of the things that are happening that will be very difficult to reverse.
I'm glad you brought up Europe because we have seen a lot of movement into European stocks. I don't want to say out of the U.S., but there has been the movement into European stocks in part because of the Germans spending more to rearm and reindustrialize. Do you think that is something that we're really going to see? I mean, you've been through a lot of cycles. You've seen a lot of boom and busts. You've seen a lot of fake starts into Europe. What do you think?
Well, if you ask me, where is the best place to invest in the world, I would say America. Okay. And I would say that, I'm talking 10, 20, 30 years. Why would I say that? I would say that because we have 25% of the world's economy with less than 5% of the world's population. We have an economy that's outgrown the rest of the world and certainly Europe over the last 2 decades. If you go back to 2008, the GDP of the US and Europe was equal. In 2016, we were 50% higher, and in 2024, we were 100% higher. So we've had a great record. We have by far the most supportive capital markets, particularly venture capital and the debt markets, so that companies can find both the equity capital and the risk capital and the debt capital to grow at a faster pace. And we have the reserve currency. So we are able to have a more stimulative fiscal policy than others. So all of those are reasons that putting a big chip on America is a good thing to do. Having said that, if you look at the stock markets today, earnings in the US are capitalized at a significantly higher value than they are in Europe. So there's normally some reversion to the mean between those two broad markets. I mean, another really important statistic is, we have 25% of GDP and 63% of global market cap.
Wow.
So that tells you where our GDP has been being capitalized relative to the rest of the world.
Wow, that's amazing.
Yeah, and Ralph, always a great conversation. Have to leave it there. Ralph Schlosstein, Chairman Emeritus over at Evercore. As we continue to count you down, that was kind of sobering, Alex.
Yeah, also it raises the question too, like as a business, and where do you invest versus as an actual investor today in the stock market, where do you make a bang for your buck, and the distinction between that?
Yeah, absolutely here. All right, when we come back here, there's another bid out there reportedly for Intel's foundry business, and it's having a big impact on the stock. It is our stock at the hour. We discuss when we come back. This is The Close on Bloomberg. Time now for our stock of the hour. Taking a closer look at shares of Intel, up about 4% on the back of a report that TSMC has pitched NVIDIA, AMD, and Broadcom about taking stakes in the joint venture that would operate Intel's factories. TSMC would run the operations of Intel's foundry division, but would not own more than 50%. Bailey Lipschultz joins us now from Bloomberg News. And Bailey, I don't know, I feel like this has been in play for a long time here. And now, I mean, investors seem to be reacting positively. I don't know if the stock is up because of this or because of just the broader market.
Feels like kind of maybe rotation back into it. When you saw the semiconductor index closing at some of the lowest levels in quite some time yesterday, Intel's still down more than 55% on the last 12 months, so maybe a bit of short covering. But at the initial announcement or at the initial report from Reuters, we did see shares pop. We have seen analysts saying if this did get across the finish line, it would be bullish for the company, but that still seems to have a number of hurdles, not only regulatory, but financial, and also the fact that Taiwan Semi came out before this report, or at least these conversations, and had said they wanted to invest in U.S. manufacturing, so maybe it would make that all moot.
But I have to wonder if this is the way forward for Intel, like some kind of larger JV partnership that helps capitalize and use its assets, but not like a full takeover or something.
Yeah, they really need to do something to get this business operating. When you look at it compared to peers, this is a company that was a huge U.S. player and has been really left in the dust when you look at AI companies, when you look at manufacturing chips. And I remember being at a conference in the fall and asking investors and analysts, like, what's the path forward? And they all kind of shrugged and said, it's just bad out there. And it's only really gotten more uncertain. So maybe this is almost a rescue without being a formal rescue.
Well, that's too why I think this is so intriguing, because everybody sort of, when you talk about nearshoring and bringing more manufacturing back and obviously national security issues, you would think Intel would have to be the primary beneficiary of that. I mean, it is probably our most important homegrown chip manufacturer, and yet investors don't seem to see it that way.
No, far and above. I think the question comes back to how does that actually get executed? Is it profitable? Is this something that can really change the makeup of a company? Which, again, when you look at how it's been operating really for the last 2.5 years, it's not executing. It hasn't leaned into AI when everyone else did. And so it's a question of, if that's the path forward, what does that actually look like? And can they figure it out, and can they right the ship?
Yeah, but anyway, the stock definitely on the move on that potential news there. Bailey, thanks a lot. Bloomberg's Bailey Lipschultz joining us. Intel stock up by about 4 percentage points. We're close. We're close to the closing bell. So I missed Monday. Monday was the crazy day. Today just feels like a nothing burger.
Yeah, Monday was crazy. Yesterday was crazy. This is a bit of a nothing burger. I mean, it's interesting to see when we talk about as soon as that CPI report. I mean, the futures were already in the green, but as soon as that CPI report came out at 8:30, you really saw futures shot up. So this does seem to be people kind of reassessing economic conditions. But they are going to have to reassess that in a month's time,
or like 24 hours.
Yeah.
Yeah.
Well, I was going to say like another 30 days.
Okay.
But sure.
Yeah. Or is a dead cat bounce? I've just been waiting to say that. All right. Kim Forrest of Bokeh Capital Partners will be joining us for the close.
I think the economy is in very good shape, not giving up on a constructive outlook at some point later. But right now, it's really all about the pullback and how far it goes. And what will essentially resolve it. I would say, the impact of the cumulative uncertainty is what I would worry about in terms of the economy.
Binky Chadha over at Deutsche Bank kicking us off to the close just about 50 minutes ago. Romain Bostic here alongside Alex Steele. Is this a rebound rally, Alex?
Yes. I thought you were going to keep talking. We're just talking about how tired I am. Yes, it's a rebound rally, obviously, a rebound Wednesday. But it's interesting kind of what's moving, and it's those that were hardest hit, obviously, which makes sense. If you're going to see kind of a bounce back, you're looking there at the stocks and the Mag 7. Even Tesla's having a good day. Apple's down within the Mag 7, which I also find interesting. Got a price downgrade over at Morgan Stanley.
Yeah.
I think the question for everybody is, do you sell the rip? And how long does this last?
And I hate to be the glass half empty kind of person, but you talk about the majority of the S&P stocks in the red, and obviously the only reason the index is in the green because of all those big names. But then you look at what's in the red, though. It's a lot of those consumer-facing names: Walmart's, Pepsi's, McDonald's, Home Depot's. I mean, what am I supposed to read into that?
Probably that's what actually did well on a relative basis during the sell-off, right? It's a safety, so it's just a flip. So and you look at the top-performing stocks in the S&P, I mean, with the exception of like Brown-Forman, it just feels like we're just reversing any earlier gains/losses. There's not the real fundamental driver yet, which raises the question, what are we waiting for now? And
it's a big question here is actually, where are we going next here? We're still well below those all-time highs, which were set just about 3 weeks ago. Actually 3 weeks ago today. And right now, we're still trading below 5,600 at the bottom end of that trading range that we had been in for quite some time. Kimberly Forrest joins us right now. She's the founder and chief investment officer over at Bokeh Capital, with just about 8 minutes, until we get to those closing bells. And I am curious, Kim, about kind of where we go from here. I mean, a lot of people are looking at the trading ranges. They're looking at these technical levels. We're clearly near the bottoms of those levels, but that's raising a lot of questions. Is there still more room to go down, or is this the support that the market had been looking for?
I wish I was a technical analyst and could be really definitive on giving you a great answer, but the answer is we don't know. I'm a fundamental analyst, and I'm looking at individual companies that have the markers for growth, right? So these are the things that I'm looking at, and it all depends on the economy. And I think the economy is that half glass full right now, where we have so many things to worry about, and yet we still chug along. And there are a few improvements, like today's CPI number. That was great news for the market, although it doesn't seem like we're thinking about that at this time. But it may have given us the bottom. Let's just call it that. Yeah. If we get another CPI, or I guess we get PPI is kind of important, but what the Fed looks at, the PCE number, that could tell us, reiterate this later in the month. So I'm looking forward to that.
Well, that's what I'm curious about, though, too. I mean, a lot of people are dismissing the CPI report today because obviously it's not really reflecting some of the policy changes out of Washington over the last few weeks. The next one should incorporate at least some of that. But as soon as that report came out, Kim, we saw futures shoot up. I mean, so there did seem to be a lot of investors like you who are much more focused in on economic fundamentals and any sort of bright spots as a reason to buy in. But how much confidence do you have longer term? I mean, I'm talking beyond February and March, but deeper into this year, the economic conditions will be supportive of at least current valuations.
Well, that's the question, isn't it? And I don't know that is a great question. I mean, I think everybody asks it. Everybody has like this What is it going to look like a year from now kind of mentality? And I don't know that the market can support that right now. So what I think I always do is look what's going to happen 3 to 5 years out with the stocks that I have today. And that's true. Not all of them are going to be in the portfolio, but that kind of smooths out all of the noise of what's happening right now. Because I don't know that anybody is going to be able to accurately forecast what tariffs are going to be put in place, what it's going to do to our economy, what if we're going to have peace, blah, blah, blah. I mean, there's so much stuff going on right now that the market's paying attention to for good reasons.
Kim, you spent 13 years as a software engineer, and you also, as an investor, lived through the dot-com crash, right? So you've had experience with this kind of volatility, particularly in the tech sector. So in that space, where do you think that 3 to 5 year time horizon is good, and kind of you look for good entry points?
Sure. Well, semis have done really well. And I think we're getting to, I hate to say this, the end of that. And why do I think that? Well, there's a lot of competition for NVIDIA's chip in AI. I also think you really have to pay attention to what problem AI is solving. And if you really believe any of today's leaders are going to be leaders 3 to 5 years from now, I'm thinking some of them will, some of them won't. And that's kind of up to each individual investor. I'm not going to give you a clue there. So you have to have a longer term vision. And right now it's hard. But I do know semiconductors are going to be the thing that runs any kind of program that we have. That's how it works.
Can you look at ancillary plays like power, infrastructure? I'm obviously talking my book in some ways here. But Kim, is that a good way to also look at it?
It has been, but I think the drivers of last year were this, that NVIDIA was going to conquer the world. There were no other chips. Like, just throw everything else out. It's hyperbole, but go along with me. And that we were going to have so much computing power to get, an answer. And I don't know, given now the deep seek issue, that that's true. So power kind of backs off. But I do know that I'm looking, and as you should be, you're looking for an AI solution that solves a big enough problem. And I'm not sure that large language models have a problem that are solved by them, other than search.
Okay, all right. Well,
because nobody really likes to use search. They don't. They like to ask a question and get an answer. And that's what ChatGPT does for us.
Yeah, I mean, hopefully we can start doing a little bit better. Kim, we have to leave it there, unfortunately. Kim Forrest, founder and chief investment officer over at Bokeh Capital Partners, counting us down to those closing bells. Alex, we are just about 2.5 minutes away from those bells here. 1% gain on the NASDAQ indices right now, largely because of the weighting of those big cap names. That's lifting the S&P, but it's not doing anything for anything else. Not the Dow, not really the Russell, and certainly not for transports.
No, we're rolling over a little bit here. The S&P is well off the highs of the session, now just up 0.5%. You mentioned the Dow. Now in negative territory. Yeah. It just begs the question, does any kind of rally at this point have strain? You're laughing at me all day.
Thank you for staying awake.
Thank you.
She's had literally no sleep.
Who said I was awake? Who said that?
Well, she's got to stay awake for just a little bit longer because she's going to stick around to help us break down all of today's market action and push ahead to tomorrow's as well. That's coming up now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Alex Seal here to take you through that closing bell. A global simulcast starts now. Scarlet Fu in the TV studio, Carol Masser and Tim Stenevec in the radio booth.
Who are you? Where are we?
Welcome.
Who are you people?
Everyone's back.
We haven't seen you guys in like how many days?
Yesterday?
I don't know.
We see you in the newsroom, but not
Friday?
Not in our little square box.
Well, you guys always ditch us for some other guy for some strange reason, but we're always here, Carol Masser, if you ever need us.
All right, that's good to know.
Yeah.
Good to know. I feel like investors have come back. They're here kind of today. Market's bouncing around again. Seeing some outperformance though, especially when it comes to some of those big tech names.
Yeah, but the direction for much of the day was kind of unclear. I mean, on the S&P 500, we were down as much as 0.5 percentage point and as high as 1.3% today. So I don't know. Are investors trying to figure out exactly which way things should be moving.
You know what? Let's just take the cooler than expected CPI report for what it was. It was a good sign, and I think investors are happy with that for now. And that's really all I can work on for now because so much is unknown.
I don't know, guys. I think we're fading. I mean, I hear you that the Nasdaq 100 is still up, but the Dow's negative. You look at the Russell, you look at the S&P, that's rolling over too, and that really just begs. If we fade into the close, that's never a good technical sign as we head into tomorrow.
And again, not to sort of look at everything through a pessimistic lens, but when you look at an S&P where the big decliners on the day all seem to be in that more consumer-facing part of the economy, your Hershey's, your Targets, Dollar Tree. Don't forget the airlines down for another day after some of those profit warnings that we got out of Delta and American here. So there's a huge segment of this economy, at least through the eyes of investors, that maybe isn't quite living up to what we're seeing on the other side of that ledger when it comes to big cap tech. And I do want to start there on the far right of your screen with the NASDAQ composite up more than 200 points on the day. Similar move for the NASDAQ 100, each up about 1.2% here on the day. And that's because 8% jump on Tesla, 8% jump on Micron, 6% jump on NVIDIA. Chip stocks, at least for today, back in vogue. The S&P up 0.5%, or up 27 points. The Dow, though, is going to close in the red, down about 0.2%. And the Russell 2000 clinging to a modest gain, higher by 0.1%.
Yeah, and to Alex's earlier point, I mean, most names in the S&P 500 are, in fact, lower today. 322 to the downside, 180, Scarlett, to the upside.
All right, let's take a look at the IMAP, which splits up the S&P 500 into 11 industry groups. A real mix here. Tech, communication services, and consumer discretionary really representing big tech names, all up by at least 1%. And then in terms of the decliners, consumer staples, as Romain mentioned, healthcare and materials, basically a lot of the sectors that had gained during this period where investors went risk off.
All right, guys, to some of the individual gainers. Vistra Corporation was up almost 12% at its highs today, finishing the day with about a 6.7% gain. Overall, we did see nuclear power stocks rising after tech and energy companies pledging support to the wider use of nuclear power to cater to surging demand from all of those data centers and also from factories. Amazon.com, Meta, Occidental, and Dow are among the initial members of what's called the Large Energy Users Group, which is backing a global effort announced in 2023 to triple the world's nuclear capacity by 2050. So a move certainly in those names. Intel up about 4.6%, finishing off an earlier gain of about 7%. That was its high intraday, but still about 4.5% higher. Reuters out saying that TSMC has pitched NVIDIA, AMD, Broadcom, and Qualcomm about taking stakes in a joint venture that would operate Intel's factories. So under this, TSMC would run the operations of Intel's foundry division. It would not own, though, more than 50%, according to Reuters, citing people familiar. Any final deal apparently would need approval, though, from the Trump administration. And Tesla, folks, check it out. Number one gainer in the S&P 500 today, up 7.6% at its gain today. Of course, President Trump highlighting Teslas yesterday. I will point out a second analyst covering Tesla is bracing for vehicle sales to drop this year rather than rebound from the first annual decline in more than a decade. So even though Wall Street commentary, some concerns, we did see investors come back in a big way in this one. It's still down a lot for the year, down about 40%.
All right. Speaking of stocks that are down, I do want to start with airlines. Romain, you mentioned it. An airline that I'm highlighting today is United, down 4.7%. But airlines as a whole continued their descent today. The latest batch of U.S. inflation data showed that airfares posted their steepest month-over-month decline since June. Stuart Paul from Bloomberg Economics was on with us. He reminded us of the seasonality here, and that this time of year we're not seeing a lot of demand, and also compared to sort of the holiday months. But it does still add to a sign of a downturn in travel demand flagged by carriers in recent days. As a reminder, this week we got two of the biggest U.S. airlines, American and Delta, slashing their financial forecasts, and a host of major retailers, too, warning about demand. This is concerns, adding to concerns about a potential recession. Harley-Davidson shares falling today, ticker HOG, down by 5.7%. One of several U.S. exporters that fell after the European Union launched countermeasures against new U.S. metals tariffs. Proposed targets including steel and aluminum products, motorcycles, beef, poultry, and spirits. Speaking of spirits, Brown-Forman, the maker of Jack Daniels, also fell on this. And then iRobot shares down 36%. The company raising substantial doubt about its ability to continue operating, and its board has begun a formal strategic review to evaluate options, including refining its debt and exploring a potential sale. Remember, it wasn't that long ago that Amazon was going to buy this company for more than $1 billion. Now it's worth just a fraction of that, just over a market cap of just over $100 million.
I thought everyone loved this thing. I'm a Dyson person, but I thought everyone loved the robot that cleans for you.
I just got one for my parents.
Yeah, the round thing that Roomba.
Roomba. I always say Roomba.
I think there are a lot of knockoffs. There are a lot of knockoffs you can.
Apparently, they can navigate around pets now. So
more like the dog will attack.
I'm more worried about the dog navigating around the thing, which that would be disastrous.
This makes a lot more sense. Okay, I'm going to the bond market here, guys, because we had a sell-off all across the curve, particularly in the front end. Right, there's some repricing maybe after that cooler than expected CPI, but the 10-year auction came in. It was pretty strong. There was a solid bid to cover ratio, and we also have the 30-year coming tomorrow at $22 billion. So we're watching that. So a little bit of a dichotomy there, right? Strong demand, like the buying coming in there, but on a day-to-day basis, seeing some selling pick up.
All right, folks. So, thinking about the market trade today, we talked about the inflation print. We get another one tomorrow, so we'll see whether or not, because within that, there's actually a component that goes into the Fed's preferred inflation read. So whether or not that carries a little bit more weight on Wall Street, we'll see.
Sorry to cut you off, Carol, but it's what I do. Adobe earnings out crossing the wire right now for the most recent quarter. The first quarter adjusted EPS did beat $5.08 a share. The Street was looking for $4.97 a share. Revenue also a slight beat at $5.71 billion. The Street looking for $5.66. Here's your guidance going forward. The company says that for the second quarter, adjusted EPS will come in a range of $4.95 to $5. The Street on average was looking for $5. Revenue for the second quarter will come in at $5.77 billion to $5.82 billion. The Street was looking for a 5.8. So a modest beat for the most recent quarter, and for the quarter that we're currently in, it looks like the top end of the guidance that they're giving would match Street estimates.
All right, let's give you American Eagle, the once upon a time teen retailer. I don't know if it still caters to teens, but it's because 30-year-olds dress like teens and 40-year-olds dress like 30-year-olds now. Anyway, American Eagle fourth quarter earnings per share, 54 cents versus 3 cents year over year. Not sure if we're comparing like with like, but the net revenue here, $1.6 billion, matches analyst estimates. And what's interesting here is the commentary that American Eagle has given for this quarter, saying that entering 2025, the first quarter is off to a slower start than expected, reflecting less robust demand, and then, of course, blaming colder weather as well.
All right, folks, we have another earnings report crossing Sentinel-1. Fourth quarter revenue, slightly better than what the Street was expecting, coming in at $225.5 million. The Street estimate was for $222.3 million. Fourth quarter adjusted EPS, 4 cents a share versus an estimate of 1.2 cents a share. And just a quick, I'm going to pull it up on my Bloomberg, and the stock in the aftermarket,
down 12%.
Thank you very much.
Now 15. Keep talking.
There we go. It was a little slow.
It's going down.
All right. It is going down. It's down about 12%, so ouch.
This is Scarlett's favorite stock right now.
Is it?
Yeah, because I'm being facetious. She loves the ticker. It's a very simple ticker, S. Which used to be the Sears ticker. Remember that?
Yeah. Until it became SHLD.
Yes, I do.
Yeah. This is all like a stroll down memory lane.
Yeah, it is.
Hey, listen, a story that caught our attention. I have no good segue here. There's a mansion in California. It's got 3 pools and a Shark Tank, and it's coming on the market for $59 million.
Shark Tank? No, thank you.
What?
Is that it?
Sorry. Oh, we are going to talk about this.
Okay, so the seller, this is according to the Wall Street Journal, is Lee Evans, a real estate developer. He set a record for the Coachella Valley when he purchased this house back in 2022. It's in Palm Desert for $42 million. This is according to Bighorn Properties, the organization with the listing. I don't know, Carol, you had me at Shark Tank. That sounds pretty good.
It's terrible. That's upsetting.
Who cleans it?
Horrible.
Who cleans it?
This is in the desert?
Yeah.
Can sharks survive in the desert?
No, it's inside a tank, house. It's in the main house.
Oh.
Wait, the fish come with the
It's
house
a hallway. It runs through an aquarium full of exotic
Is a shark
fish,
a fish
and beneath an overhead shark tank. Yeah.
Do you get the fish, though? Do you get the shark with the house?
I think
is a shark a fish, Scarlett? I don't want you to disrespect sharks.
Okay, sorry. Fish. Well, are fish also in the Shark Tank? Can fish survive with sharks?
I don't know. Is a hot dog a sandwich?
How do you feed
we can keep going. I don't know.
Existential questions during the close.
I think there might be 2 tanks.
Yeah.
There's an aquarium.
So it's a nice view,
fish,
but,
and then
but
beneath
that house is
an overhead Shark Tank.
Well, okay, quick question. If you had $59 million burned in a hole in your pocket, would you buy it?
No.
No, I'm terrified of sharks, guys. So this is
It's
really
in a tank, though.
Literally my worst nightmare come true.
It could be like a James Bond
Until like the
villain.
high fuel hits the Shark Tank and then everything comes crashing down. That was like a movie.
Does anybody have a shark fin? Can we just cue the shark fin effect for Alex?
Nope, that's copyright.
We have cricket.
Oh, we did it.
We have the cricket
Oh
effect.
my God. Romaine does shark. Love that. All right.
Wonderful.
We got to wrap. That's a run. We got to run.
Blew my street cred.
I know, totally. All right. That is our cross-platform coverage. We do it on radio, TV, YouTube, Bloomberg Originals, and wherever the sharks are. I think Alex is heading out, but Scarlett and Romaine are continuing on TV. We are going to continue on Bloomberg Business Week.
And a lot more coming up here on Bloomberg Television, a deeper dive into economic conditions and, well, what to expect for the year ahead in markets. Jeremy Siegel going to be joining us after the break. This is The Close on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. I'm Scarlett Fu.
And I'm Romaine Bostic. The market had been looking for a rebound. It got it. It wasn't the most meaningful rebound in the world, but given how much this market has traded in such a tight range and down over the last 3 weeks or so here, I think some people would take it. Only about a half a percentage point higher on the S&P 500. You got about 1% gain on the NASDAQ, and that was largely because most of the gains today actually came from big tech. More on that in a moment. You see the Philadelphia Semiconductor Index up 2.5% on the day, but there was a lot of weakness out there, and there are a lot of concerns about economic conditions. Most of the stocks that we saw in the red today were consumer-facing stocks, your Dollar Trees, your Targets, and don't forget about airlines. That was a big part of the reason why the Dow Transport Average was down again as well. Of course, those profit warnings that we got yesterday over the last 24, 36 hours from Delta and American, investors still concerned about that.
Absolutely. And speaking of consumer-facing companies, let's start with iRobot, the maker of Roomba. It tumbled after saying there's doubt about whether it can continue operating as a company. The stock losing about a third of its market value. The board is now formally looking into strategic options, basically a possible sale or maybe even refinancing its debt. Remember, this is the company that Amazon was trying to buy, but regulators wouldn't let it go through. Intel gaining almost 5% on the day on a Reuters report that TSMC has pitched NVIDIA, AMD, Broadcom, and Qualcomm about taking stakes in a joint venture that would then operate Intel's factories. Again, that's on a Reuters report. And Microsoft down, or I should say, paring some of its gains, gaining only 0.75% after Bloomberg learned that the FTC under President Trump plans to move ahead with an antitrust probe of the software company, basically continuing the work that the Biden administration has begun. So indicating that at the FTC, at least, they continue to scrutinize what's going on with big tech companies. Now, our top story this hour is CEOs meeting with President Trump this week. They made their case for the need for market stability and some certainty. Instead, what they're getting is more uncertainty as Trump continues to lob threats to impose tariffs on the U.S.'s biggest trading partners, Mexico, Canada, China, the European Union. In fact, State Street is now at risk of losing $52 billion of Swiss pension assets. Worried that Trump may target Switzerland next, you have lawmakers in Bern introducing a bill to force the state to move custody of the assets from State Street to a Swiss bank. Romaine?
All right. Well, it's kind of interesting, Scarlett, because we want to hear what those CEOs have to say, and they are speaking. While earnings season is winding down, a few stragglers. We heard from SentinelOne just a minute ago in the software space, some concerns here about their forecast, and now UiPath, the software company that specializes in robotic automation, down 19%. Their numbers for the most recent quarter did beat, but the guidance that they're giving for the first quarter and beyond looks light. For the first quarter, here's your forecast. The company sees revenue of $330 to $335 million. The top end of that range is well below the average of street estimates. Adjusted operating profit would also come in below estimates, $45 million. That's the guidance the company is giving. The street was looking for $48.3 million. We should point out the number on your screen there, down 18%. That makes us the biggest mover in after-hours trade to the downside. Second biggest mover is SentinelOne. Also near the top of the leaderboard is Adobe. Those shares only down about 2%. They've been fluctuating back and forth. We just got earnings out of them. The company did beat on some key metrics for their first quarter. But for the second quarter, they gave guidance, at least a guidance range, that on the bottom end of that range would come in below the average of street estimates. Let's bring Anurag Rana into this conversation right now, one of the best over at Bloomberg Intelligence, and just kind of break down. I mean, and I should just point out, Anurag, the guidance isn't awful. It is a tad light. But I am curious here about what we can expect out of this company, not just for 2Q, but in the quarters beyond that as well. What did we learn out of this report today?
Yeah, Romain, one of the things I would say is the biggest question was what would be their digital media annual recurring revenue growth rate for the full year, and they maintained that guidance. So the 2025 numbers are clean. I think that's a relief given all the headline risk we've been hearing about Adobe. But as you said, the stock popped up initially. Now it's down a little. We want to learn more on the call about what's the core business doing.
Let me just jump in here, Anurag. We got some news out of Intel. It has announced a CEO change, a long-awaited announcement, in fact, saying that its board of directors appointed Lip-Bu Tan. He is an accomplished technology leader, according to the statement, with deep semiconductor industry experience. He will be CEO effective March 18th. Zinsser will remain executive vice president and chief financial officer. Jonathan Halthouse will remain CEO of Intel Products. So once again, Romain, Intel announcing a CEO. I don't know that this is a name we knew was in the running.
Yeah, it certainly wasn't. It jumped. And when I saw it across the wire, my first reaction was like, wow. I think a lot of us had assumed that maybe Zinsser might actually keep the job. There were some other internal candidates.
Yeah.
We also know that we're in contention here. But maybe this provides some clarity, right? Because this was kind of the whole knock on Intel. The idea that once we kind of knew that Gelsinger was going to be moving on, the idea this kind of put the company in a bit of a limbo situation at a very critical time when they really didn't need to be in limbo. So there you have it, a new CEO here.
And we're seeing shares of Intel move higher in the after-hours trade. All right, let me thank Anurag Rana really quickly here for joining us, for giving us the instant analysis to the Adobe results. We want to continue our coverage of the markets right now and take a look at the overall equities picture here, because there was a cooler than expected CPI print this morning, and it did offer some relief ahead of the tariffs that are expected to drive costs higher. Jeremy Siegel is Professor Emeritus of Finance at the Wharton School at the University of Pennsylvania, and he joins us now. Jeremy, Professor Siegel, you might as well be Professor Wharton at this point. Thank you so much for joining us today. In terms of looking at today's market action, the price action, we got a bit of a rebound. How do you determine how much more selling pressure there is in the market right now, or whether this floor that we seem to have gotten will stick?
It's hard to see a lot of upside potential with these tariff wars being battled back and forth. I think that's far more important than the CPI today or the PPI tomorrow. We do have the Fed next week, which will be of interest. I think that actually might have a hawkish tone. We could talk about that if you want. But the overriding factor, I think, influencing the market is definitely the tariffs. And no clarity, a lot of, bad sentiment, bad reactions on both sides, feelings that it takes time to heal.
Yeah.
You already talked about the fact that is Switzerland going to pull some funds from State Street? The ramifications could be much broader than even the narrow tariffs that we see right now. And I think that is overriding the market.
Yeah, there's clearly a lot we don't know in the near term and medium term. Tariffs, government shutdown, taxes, geopolitics. The uncertainty can be crippling, and we're seeing the damage play out in the equity market over the last couple of weeks. Yet there is also quite a bit of certainty when you look at things from a bottom-up perspective, right? There are companies with fortress balance sheets. There are companies with dominant market share. Professor Siegel, what are you most confident about in this current environment?
Well, I think there's, I don't think we're going to have a recession. I think the balance sheets look great in the market. I don't think the market is overvalued. And it certainly doesn't mean that there isn't downside. I think there is downside, but from a long-term standpoint, right now we're, I think, under 20 times earnings. I've often said that 20 times earnings is pretty much of an equilibrium. So, and we have, if you take out the tech, which are still higher than 20, you're getting many stocks 16, 15 times earnings. These are great values. We don't see really any disturbance in balance sheets. The high yields are behaving very, very well. So again, it isn't like we're on the precipice of some sort of financial crisis, 2007 or anything like that. And I think that those are fundamental strengths. A long-term investor should not be concerned in terms of should I yank everything out of the market? My statement would be definitely do not. I just don't see a lot of upside right now until we get some clarity, hopefully on April 2nd, when, we're going to get the reciprocal tariff study. And maybe, Trump could be persuaded, let's go to each country where they have tariffs that are high. Let's try to negotiate those down, and then we'll drop ours. I mean, that's what everyone was hoping for, rather than this, 20, 25%, let's slap it on Mexico, and then all of a sudden we're getting these retaliation, and then he's upping the ante to 50%.
Yeah.
This is not at all what the market wants.
It's not. And it was kind of interesting, too, the Trump to make an appearance at that quarterly business roundtable meeting to actually hear from some of these CEOs themselves. And obviously, we don't know exactly what went on behind closed doors. But these obviously are people that, at least in my view, I would think Trump would have some degree of trust in terms of trusting their opinions. And it gets to this idea, Jeremy, that for all of the chaos and talk, not a whole lot has been implemented. I mean, these 25% tariffs that went into effect today, I mean, that's it. I mean, we had the 10% ones on China, but a lot of the other ones, and you mentioned April 2nd, we're still waiting to see whether they're implemented. And if they are they going to be at that 25% level or maybe something a lot less based on what they negotiate? So is there a sense that if we do get some stability in all this, not necessarily a reversal, but some stability and clarity over the next few months, does that give this market an opening to resume a rally?
I think it would be an opening, but I think it does depend on what it settles down to. And, for instance, certainly I think everyone was expecting a surcharge on China, and we did get a 10%. I was not expecting, just a blanket 25% on Canada and Mexico. You remember a few weeks ago we put it on, then immediately took it off, and I thought it would wait until April. And now it seems to be put on again. And I think that, I think that up and down then says, I don't know where Trump is going to go. I certainly, agree with you. I hope he got some feedback today from some business leaders that uncertainty is not good for business, is not good for the stock market. As good as some of the long-term goals might be, the short-term turmoil is very much more detrimental, in my opinion. A threat of a recession. Recession, you lose 5 million jobs. He's talking about in 4 years maybe bringing back, maybe 500,000 at best manufacturing jobs, and that could be 3-4 years out. I mean, it seems like way too far in the future, and honestly, I think the average person say, hey, I don't care if there's an extra factory there in Erie, Pennsylvania making dishwashers that maybe I could buy today abroad at 40% less price than when they're going to be made sometime in the future with tariff protection. I mean, there's this question of what is this long term on the tariff side that he really wants. If he wants to lower tariffs across the board, let's get them back down to 1-2%. I'm all for that. That's positive. Honestly, I'm not sure now exactly whether that is his goal or not.
Yeah. So excuse me, Professor Siegel, but what is the narrative, though, then, for the market? I mean, if everything you said, and I think a lot of people have similar views with you, but what then becomes of the market narrative, if there is one at all? I mean, I just don't know what it is right now.
Well, I think what it is, why is the market down 10%? Because, with these tariffs and disruption, earnings could be down 10%. In the short run, they could be down more. Now, I don't think there's going to be a recession, but I think every single Wall Street firm has at least raised their probability. I know Larry Summers now says 50. I don't think it's quite that high, but everyone is now saying, it is a higher probability, and that means earnings are falling, and earnings are along with what happens to interest rates, the fundamental, in fact, probably more fundamental than even interest rates at determining stock prices, because you cannot have stock prices without earnings. If earnings are going to be hurt by a slowing economy or a recessionary economy, so that is the fear. That's what I mean. It doesn't puzzle me why it's down 10%, and everyone's just waiting. Is he going to ease off, or is it going to get worse? And so we're stuck in that zone of uncertainty right now.
Absolutely. Professor, always a great conversation. Jeremy Siegel, Professor Emeritus of Finance over at the Wharton School. And we should point out, we're in kind of that heart of warning season as the end of the quarter is upon us. So companies that feel a need to express something material really only have about a 3 or 4 week window to kind of get it out there.
It might be a good time to do it, too, given there's so much noise. You can get a lot of information out there. Maybe investors won't punish you too much for it. All right, let's get to the top three, where we name dropped some of the people driving the day's most talked about stories. And first up is Bill Simmons, the podcast host and media executive, sticking around at Spotify. He agreed to a new contract to serve as Spotify's head of talk strategy for at least 2 years. Remember, he sold his company, The Ringer, to Spotify for $250 million during the pandemic.
Well, good for him. No terms really disclosed in that story as to sort of what he's being paid to stick around here. Another person I'm keeping an eye on is Michelle Bowman. We're now learning that the Fed governor is potentially set as Trump's pick for vice chair for supervision at the central bank, basically the so-called top cop here. Again, this is people familiar with the situation saying that the Trump administration is ready to tap her for that position.
All right, the Senate does need to confirm her nomination. And third on the docket is Carson Block. The CEO of Muddy Waters Capital says he still would not bet against Elon Musk despite the recent drop in Tesla.
This guy for years and years and years has done nothing but pull rabbits out of the hat. Just when you thought like he was about to go over the edge of the cliff, he comes back. So it's just a very difficult person against whom to bet.
So if you believe in Tesla, maybe you're rooting for Donald Trump to get tired of Elon Musk so you can go back to managing the companies.
That's one take. Certainly so there. All right, we're going to continue our focus here on economic conditions.
Canada pushing back against President Trump's 25% tariffs on steel and aluminum imports, with fresh tariffs on products made in the U.S. Joining us now with the latest is Mathieu Dion, Montreal bureau chief of Bloomberg News. And ironically, Mathieu, some of those tariffs that Canada is imposing is also on steel and aluminum, but from the U.S. to Canada.
There are reciprocal tariffs worth $30 billion Canadian dollars. And if you convert that into U.S. dollars, it's a little bit more than $20 billion. So steel products worth $12.6 billion. Aluminum products worth $3 billion. Also additional U.S. import goods, consumer goods, computers, sporting goods worth $14.2 billion. And the long and extensive list just came in the last few minutes. And these tariffs will add up to what was announced last week, because Justin Trudeau's government announced that he was imposing some tariffs on worth $30 billion of U.S. imports, especially consumer products such as alcoholic drinks, cosmetics, peanut butter, and all this in response to what Trump is doing with tariffs right now.
I'm curious, Mathieu, is there any issue here with regards to the leadership in Canada that the approach that they've taken to this trade war could change once we get the new elections, which would in theory take place in a couple of months?
So Mark Carney was not sworn in yet. It should come up in the next coming days. But so far, what has been told out there is that what's announced, what's being done, is aligned with Mark Carney's thinking right now. So it should not change so much. But during the campaign to become the Liberal leader, he was much more pragmatic, and his stance was much more moderate than the other candidates at the time. So we'll see what will come out once he's prime minister officially. But for now, it should stay the way it is.
All right, Mathieu Dion, of course, our man up there in Canada, as we keep a close eye not only on the tariffs coming out of the U.S., but the retaliation coming out of its allies. Nirupama Rao joins us right now, assistant professor at the University of Michigan Ross School of Business. And Nirupama, we've kind of been through this before, so I know things are different now, so we put that asterisk there. But we do have somewhat of a template of what a tariff war looks like and what the potential economic fallout could be. Is the parallel a true parallel?
I mean, last time tariffs were 25% on steel, 10% on aluminum. We're going higher this time with aluminum. And I think it's actually hard to see what the economic argument there is. You know, U.S. supply, especially of aluminum, is not particularly elastic. So production doesn't increase that much despite the high prices. So last time, you know, I think aluminum prices went up twice as much as steel prices, despite having a lower tariff rate. In fact, prices were so stubbornly high due to slow growth that they started exempting steel and aluminum from Canada and Mexico.
Well, that's what I'm curious as to whether we end up back there again. I mean, I started my career actually covering the steel industry, and I've seen how little capacity we have now relative to when I started my career, which was only 5 years ago. But it was quite some time ago. So the question is, where does that supply come from? We don't have the capacity to match that, what we would lose from imports, assuming that people don't want to pay that 25% tax.
I mean, it's going to come from abroad, just at a higher price. So what we saw last time is that higher price, right, has consequences. Before the last round of tariffs, the U.S. used about 100 million tons of steel a year. After those tariffs, it was just 93 million tons. We saw less steel being used. Users of steel, right, home builders, automakers, the company making your washing machine will find a way to make that washing machine with a little less steel. Right? Maybe the drum's a little thinner. Maybe the parts are a little bit different. So that's where we're going to see it. I mean, frankly, it's one thing to double down on a policy that you think is going to actually achieve your goal. And, there will be other consequences for the broad economy, but this is a case where it's sort of doubling down on something that didn't work the first time.
You're talking about workarounds, companies using less steel to make a washing machine, for instance. But the president's response to this is that his strategy is to repatriate U.S. production and with it jobs. And these may not be jobs at American companies, which I think can get confusing for some people, right? Because Alcoa lobbied against the 25% aluminum tariffs on Canadian imports because most of its manufacturing facilities are in Canada. Trump doesn't necessarily need to see American companies bring back jobs. It could be any company bring back jobs.
I mean, the question, though, is, it could be anywhere, absolutely. And there are many foreign companies that operate in the United States, right? We have foreign steelmakers, foreign auto companies, right? And so those jobs may actually, at the end of the day, contribute to the bottom line of foreign firms. But I think the hope is that it would improve jobs in this country, increase jobs in this country. But the question is, what about the overall jobs outlook? Like last time, we put the metal tariffs in and we got a few thousand more jobs in, metal production, smelting, et cetera. But a few thousand jobs in those particular industries, at the same time we could lose tens of thousands of jobs in the affected industries. And some of those jobs that we might lose in manufacturing, studies peg it at 75,000 jobs potentially, they are better paying, better jobs than some of the smelting jobs we might get.
Oh, interesting. What do how do companies who are facing higher costs, the ones who cannot get rid of all the steel in their washing machines, do in terms of passing on costs? I mean, is it just a given that they're going to pass it on, or can they absorb a little bit of it, and will corporate America and shareholders accept slightly lower profit margins?
This is such a good question. So the way a tariff operates is it's like a supply contraction, right? And the way I teach my MBA first-year students, it's like a shifting into the supply curve. You could have this lead to higher prices. You could have this lead to lower quantities, right? And, this particular economic moment, unlike 2018, which was a much stronger economy, we are seeing these glimmers of sort of maybe weakening consumer sentiment, maybe slightly less optimistic businesses, including small businesses. So that weakening of demand in the background might actually mean that we get less pass-through. Right? We might have a situation where companies maybe eat a little bit more of it. Last time, I think, the economic studies say that they were all passed through at 100%, except for steel was 50%. And this time we could see a little weaker pass through. In fact, I saw you guys had the CEO of Chipotle on earlier this week, right?
Thanks for watching.
And he mentioned, that if the tariffs go through, they'll probably face higher avocado prices. And he said that Chipotle would eat that, rather than pass it on to the consumer. But the question we have to ask is, a Chipotle with narrower margins, is it going to open as many new locations? Are investors going to allocate as much capital to a Chipotle that has lower margins? Those are the big growth questions that we don't know the answers to in a world where we're facing tariffs and potentially not passing them through.
There's also the concern, too. I mean, when you talk about the way that a lot of those costs were passed on last time, I mean, inflation was in a much different place. So now you already have high inflation, relatively high inflation on a historical basis, but you also have the imprint in a lot of people's minds. A lot of people are still going to the stores, whether it's for durable goods or their everyday goods, and they're still seeing prices higher than what they used to be. So is that going to make them more sensitive to all of a sudden if that washing machine goes up, say, 5 or 10%?
I mean, the tricky part of inflation, right, is that inflation expectations can be self-fulfilling. And so, you know, we may see in some categories, we may not see full pass-through, but consumers are expecting higher prices in every survey. And I think they are probably girding themselves to prepare for those higher prices, right? I think I've seen reports that private label producers, you know, who benefited as consumers kind of went down the sort of reputation gradient of products, are now seeing weakening demand, right? Which suggests that some of these price increases. Bloomberg has reported that too. Yeah, we report everything.
Nirupama Rao, thank you so much for joining us today.
Thank you so much.
And thank you for watching our programming, too. Shout out to the Chipotle interview we did earlier this week. Nirupama Rao is a professor at the University of Michigan. Romain, if you look at how stocks fared on the day, we had our first gain this week, that benign inflation report, giving a little bit of relief for those who are concerned about inflation and the growth scare. The Mag 7 in particular gaining about 2.25% on the day, and yields climbing across the curve.
Yeah, and it'll be interesting to see whether this actually continues. Of course, we do get the PPI report tomorrow, but I think more importantly, a lot of this really does come down. And I think what Jeremy Siegel was getting to, really April 2nd, it's really about whether we do get some sort of stability out of Washington policy and whether that's enough to calm the markets. And of course, we still haven't seen the effects of what's already been implemented.
Yeah. Do you think we're going to get pushed out from April 2nd to, you know, May 1st or May 2nd?
I mean, that's the problem, is I don't think anybody knows that answer. And I think that's where a lot of the anxiety in this market's coming from right now. There's a lot else going on out there, particularly in the world of semiconductors. We're going to talk about that in a minute. We're also going to use it as an excuse to take a look back at this day in history and Fairchild Semiconductor. This is Bloomberg. All right, let's take a look back in history. On this day, 28 years ago, and the unofficial end of an era. That was when National Semiconductor completed the $550 million sale of its legendary Fairchild Semiconductor division. Now, the sale of Fairchild was remarkably unceremonial, a middling end for one of Silicon Valley's founding companies, a company that spawned dozens of the best-known tech ventures that exist today. Its history in a nutshell began in the mid-1950s when a group of 8 engineers working for transistor pioneer William Shockley left in a huff and started their own company. A key member of that octet, Gordon Moore, who was just a few years later, would observe that continual technological improvements would allow more and more components to be squeezed onto smaller and smaller integrated circuits, which in turn would foster further technological improvements, the so-called Moore's Law. And it ignited a frenzy of innovation at Fairchild and across Northern California. Not to mention a frenzy of financing to support it all. Fairchild is often referred to as the first trillion-dollar startup, a nod to his expansive family tree of employees who left to build bigger and better things. Arthur Rock, who helped fund Fairchild's birth, later bankrolled Apple. Fairchild co-founder Eugene Kleiner, well, he started the venture capital firm Kleiner Perkins. And Fairchild employee Don Valentine, he would leave to start Sequoia Capital. Gordon Moore, along with Robert Noyce, would leave to form Intel. Jerry Sanders, he left to found AMD. And Wilfred Corrigan, he left to found LSI, which was later absorbed into what is now Broadcom. The number of so-called fair children is vast. A report by Endeavor Insight estimated that of the 100-plus Bay Area tech companies trading on the NASDAQ and NYSE, 70% trace their lineage directly back to the founders or employees of Fairchild. Now, sadly, Fairchild became a victim of its own success, never fully recovering from that exodus of talent that seeded what we now call Silicon Valley. Fairchild today does still exist, in name, if not in operation now, a small division of ON Semiconductor. Scarlett?
All right, we're going to stay on the semiconductor theme here and just give you an update here on Intel. Shares up about 11.5% right now after the company named chip veteran Lip-Bu Tan as its next CEO. Joining us now for more on this is Bloomberg's Jackie Davalos. Jackie, tell us what we know about this decision.
Well, what a great segment to start this off with. Intel's another Silicon Valley icon that has really been struggling, and this latest change is going to see Lip-Bu Tan come on as the fourth permanent CEO in the last 7 years for the company. This is a major step that comes after Pat Gelsinger was, of course, pushed out by the board just in December. Now, Bhutan is a well-known quantity at the company. He served on the board prior and will be coming back. He departed just last summer as part of the deal. He's coming back on the board, starting formally in his role on March 18th. So you know that they're really working quickly to have him take over. He's taking over for the co-CEOs who have been there on an interim basis, filling in for the company, trying to shepherd it through this massive change. Of course, Scarlett, as we know, Intel is one of President Trump's focuses right now to bring domestic manufacturing for chips that are crucial in AI development right now. They have been trying to build out their foundry business and have been struggling to really make that work and have also been losing market share to NVIDIA. So the struggles here have been coming on all fronts. He has a lot to work on as he takes over this role.
Yeah.
Jack, I'm sorry.
I had a lot of experience in this area as well, Jackie. I was just looking at his, I didn't know a whole lot about this guy, but through his investment firm, Walden, he's had his hand in so many chip companies over the years, like Cadence, Ambarella, Creative Technology as well. Jackie Davalos there out west.
All right, from Silicon Valley to Wall Street, corporate leaders meeting with President Trump in Washington. This, as David Solomon of Goldman Sachs says, CEOs want more policy certainty. Earlier on the close, Binky Chadha of Deutsche Bank said he is keeping a close eye on CEO sentiment.
What we've seen so far is confidence measures come down, consumer confidence, and I would say not enough attention is paid to CEO confidence, which we think is absolutely key for the cycle.
Joining us now to discuss is Peter Atwater, president of Financial Insyghts and adjunct professor at William & Mary. Peter, thank you for speaking with us. We talk about CEO sentiment and how that's a clear metric for a lot of people to monitor. Right now, sentiment is uncertain, and that means people are paralyzed from making decisions. At what point does that paralysis turn into decisions, and what might those decisions look like?
It's already turning into decisions. We need certainty. We need a sense of control in order to plan, to make investments in business, to make investments in the market. And what you've seen since Inauguration Day is a decline in leadership confidence within corporations, and investor confidence is measured by the markets.
The other thing is some leaders might agree with President Trump's tariff policies and what he aims to accomplish. Others might not. But it doesn't matter whether they agree or they don't. They're more interested in some kind of plan, a clearly articulated plan, so that they can move forward as well.
Yeah, business leaders need a vision. They need some sense of certainty. And as I tell my students, bad certainty is better than no certainty in the chaos that exists. We can plan around it. We can manage the vulnerability that is generated from that. But this sense that events are random, they're constant changing, that precludes any sense of long-term strategic process in the business.
I am curious, though, Peter, and I'm just kind of playing devil's advocate here, though. I mean, we have an administration that has a lot of CEOs and business leaders, if not in the cabinet, certainly in advisory roles. You have a president himself who fancies himself as a business man as well. I know that the way he goes about things is scary, that there's no doubt about that. That's just fact. But is there any sense here that there is some degree of kinship amongst broader corporate America and the people actually running this administration?
Well, I think that there's a distinct difference between the environment that existed in the first administration and today. There was a sense that there were adults in the room, seasoned business leaders, not just financiers. In the cabinet, folks who understood the management of business, but even more so is the introduction of Elon Musk. And you know, if you go back and look, Musk has been referred to as the Trump of Silicon Valley, Trump the Elon Musk of Washington in the past. And I think what you have this cycle is an amplifier, where in the prior administration there was a sense of outsiders calming and softening the edges of the president. I think there is a sense this time that what Musk is doing is in many ways bringing out the worst of Trump's instincts.
How do these CEOs, and for that matter, their deputies, sort of respond? Because if this is the new world order, for better or worse, their job as CEOs is to navigate that. I mean, they're supposed to be able to make profits for their shareholders in good times and bad, no matter who's in the White House, no matter who's in Congress. So does this end up being just more of an adjustment period for these companies, or should we maybe prepare ourselves for something worse?
I think you have to prepare yourself for something more significant, because what you're seeing is a sense of vulnerability across multiple industries, across multiple geographies at once, where, the U.S. was once welcome. Today, it's creating adversaries among former allies. And so the natural CEO response is to address that vulnerability by creating financial resilience. And how do you do that? You look at labor costs, you look at capital expenditures, you look at the levers that you can pull now, and you're already seeing that happen. Look at the airline space, look at higher ed. Industry leaders are responding to this as they have no sense of the chaos coming to an end.
What does seem to work for a lot of these CEOs and for industry groups is making a trip to Washington and getting in front of the president and his team, making your case. We've seen that with the automakers. We've seen that with some of the steel companies as well, certainly when President Trump announced the 25% tariffs on steel and aluminum imports. But what is the cost of having your CEO spend so much time making these personal appeals?
Well, you have CEOs who are responding to, instead of a ready, aim, fire mindset, a fire, ready, aim. And so they're having to do damage control and make their case one at a time. You have lobbying groups that are trying to do the same, but everything is transactional, everything is immediate, and more than that, there is also a desire for great theater in this and great television. And that makes it very difficult to run businesses that have long-term investment plans.
How much clout, though, do some of these companies have in terms of being able to lobby Washington? And we should point out, I know we're so focused right now on the White House. In theory, we are sort of a nation of, three branches of government. And so I am curious as to whether there is a potential reprieve in not just lobbying Trump in the White House, but lobbying Congress to maybe be some sort of moderating effect. And if that doesn't work, obviously, there's the courts.
Well, I think right now there is an inclination not to speak up. I mean, the Wall Street Journal shared an article coming out of the Yale conference yesterday where CEOs are reluctant to speak publicly about the impact of all of this on their businesses. And I think that what we'll see is that spines tend to grow as confidence falls. And the question is, at what point do business leaders feel that they need to speak up, if only for their employees and customers?
All right, Peter, great stuff. Peter Atwater, president of Financial Insyghts, an adjunct professor over at William and Mary. As we wrap up the trading day here on this Wednesday afternoon, we're going to set you up for what investors will have their eye on over the next 24 hours. This is Bloomberg. Well, the market's got a pleasant surprise this morning out of that benign CPI report. Let's see what could potentially move the market tomorrow. We do get some economic data out of Germany, France, and Spain, their inflation numbers. But I think the PPI numbers, Scarlett, here, 8:30 a.m. Washington time out of the U.S. could be more important.
Yeah, month over month, we're looking at 0.3%, whether it's core or not. For the year over year, we're looking at least at 3.3%. So those are the big numbers to watch there.
Yeah, and we should point out, of course, these numbers are backward looking. They're not necessarily going to reflect some of the changes that have been coming out of Washington. So always keep that in mind. Now, you might get a little bit more insight out of some of the earnings that we get tomorrow. A lot of consumer-facing companies.
Yeah, Ulta Beauty will be reporting. I mean, it's a small priced item, but it speaks volumes about how much people are willing to spend. Dollar General as well, and Williams-Sonoma, higher priced.
Yeah, that's much higher priced stuff. Do you ever buy their Christmas stuff? They have the peppermint bark.
It's a little too high.
$100 a pop or something.
Yeah, no, not $100
All right, we'll be here
a pop.
for all your market moving coverage tomorrow. For your politics coverage, stick around. Balance of Power is up next.